I'm your host, Jason Raznick, founder of Benzinga, a leading platform in the financial world with the mission to level the playing field for individual investors. And this is the Raz Report podcast, where we share inspiring stories, expert advice, and exclusive perspectives to keep you ahead of the ever-changing world of investments and entrepreneurship. Let's dive into the show.
Welcome to this edition of the Raz Report. Excited to have this guest on. We're going to learn about how to make yield of the markets, someone who's been at VanEck for many years. We're excited to have on Fran Rodilosso. His family debate is the last name, but you can Google him, and I'll spell it for you, Rodilosso. But he's the head of fixed income, ETF portfolio management at VanEck, 20 years experience of fixed income, specialized in emerging markets, high yield bonds. Who doesn't want to make high yield as interest rates seem to be coming down? Well, I guess they're lowering short term. I don't know. We'll talk about that. And then we'll talk about your beginnings and how you got into this. But before we get into finance and how you're going to help us learn how to make money, so you've made a name for yourself in finance, but you started with a history degree from Princeton. What's the story behind the career shift? Like, did you think you were going to go into like teaching, or you just really had a passion for history and then got into finance?
Yeah, fantastic question. I believe it or not, I applied to Princeton to be an engineer. And the summer before I arrived, I decided that probably wasn't a career I'd pursue. And I liked the idea of a liberal arts education. I really chose history because of a fascination with Latin America. And so my concentration within the history department was Latin American history. And at the time, a big focus on sort of, this was in the 1980s when the debt restructurings were just beginning. So a lot of boom and bust and debt dependency. It naturally led into my career path, even if it wasn't intended when I first chose the major.
Got it. And you said you're passionate about Latin America. So you're this 18-year-old person going to Princeton. How did you become passionate about, or when did you become passionate about Latin America, and why?
I developed that through a few classes I took early on. I did my freshman year advisor happened to be a Latin American history professor, so he steered me toward not just his class but a couple of others that got me super interested in many topics, not just in the economics and history of dictatorships, et cetera, but art and culture and the whole nine yards.
Okay. While you were in college, though, you did develop a passion for the markets. I mean, you were paying attention to the markets. Was that you were watching Drexel Burnham? Like, how did you become passionate about the markets? Because it's not as accessible as it is today. I mean, it wasn't like you can just go on the internet and look up markets.
No, that's really true. I had some I took a lot of economics classes. I mean, that tied into some of what my major was. Also had, one of my first economics classes, Alan Blinder was a professor.
Oh, really?
You have great professors there. Someone had told me, make sure you take accounting at any stage that it's available to you. So I had just taken that for functional knowledge. And those classes, those professors sort of, make sure you look at the journal, make sure you kind of know what's going on generally in the market. While I was in college, sophomore year, I believe it was, we had Black Monday, which drew a lot of people into, wanting to know more about what was going on.
Yep.
So it was, you didn't have to take that many classes within your major there. So I had the opportunity to take a lot of economics and accounting classes.
Got it. So right out of college, did you get right into the markets? Did you go?
I actually, my first job out of college was on the floor of the New York Mercantile Exchange under the old open outcry system. And I was a phone clerk, basically taking orders in the pits in, crude oil and heating oil and gasoline futures. And in the early 1990s, it was quite a crazy scene, actually. It's a good way to understand market psychology, but in a lot of ways, a lot less sophisticated than fixed income.
Yeah. So you definitely probably, I'm assuming, have some memorable moments from that trading floor, because it's not like how it was back then? Any things offhand that like any crazy memorable stories?
Well, two. My first day was basically the first day that the market was open. My first day on the floor when I was just getting oriented uh, was the first day the market was open after Iraq invaded Kuwait. And about 6 months later, when a negotiation broke down, it was this, maybe one of those days where I think crude oil spiked. This was probably January or February of 1991. Crude oil spiked $15 or $20 in a matter of minutes. And sadly, but interestingly, there were a couple of options based, more proprietary shops on the floor that were there that day, and their booths were empty the next day. You could a lot of money was made and lost extremely rapid fashion. So it was crazy.
So that was
That and
like a rude awakening. A lot of action the first day you're there. I mean, that was just action,
yeah.
right?
And then over the course of a year, I went to business school after that. I was there just a year, but there were fist fights, people cutting phone lines with scissors. I mean, it was really quite interesting.
So cutting phone lines with scissors to get the advantage, so someone else wouldn't get the trade in, or is that basically
It was actually an act of pure anger on someone's behalf, who felt their way to the pit was being hampered. So it was.
You can make a movie out of it.
Yeah.
Yeah.
So anyway, it was really, really interesting.
Okay. So something you said in one of your interviews, one of the things you liked was finding unique ways to make income. Like, so you were buying futures or you're buying the treasuries and you're finding ways to create yield. We're going to get into, the ETF, income ETFs, but do you still do that? Do you find you were talking about arbitrage opportunities. Do you still find these arbitrage opportunities that exist?
Yeah, I mean, my first job after grad school was actually a fixed income arbitrage desk. I think it's more and more difficult to find, pure arbitrage opportunities in today's markets, but I think there are, more relative value opportunities than say pure arbitrage. So, in other words, you can identify good risk reward opportunities relative to the rest of the market or the market in general, and that has a lot to do with where you are on the curve at a given point in time, or which parts or corners of the credit market appear to be undervalued versus others. And just to sell ETFs in general, that's a vehicle that cuts the market up so many ways, allows everyone to take a stab at that type of opportunity.
Okay. And so we're going to go into what, VanEck has tons of different ETFs. You're watching a CNBC or Benzinga, you definitely see, the different ETFs VanEck has, but I want to go into income ETFs. So for those who are listening and considering different options to invest in the market, what would be like the 101 on what are income ETFs?
Sure. The 101 is they're not really structurally that different from, say, your bond mutual funds. The difference is, like equity ETFs, these trade on exchange every day. And so you can buy and sell them. What's really great about fixed income ETFs, the way I look at it, is they're super cost efficient, so low fee. Number one. Number two, they're super transparent, meaning almost all of them every day, their holdings are published. Number three, they should be easy to understand because many of them track a very basic index. So you're getting market beta. So you know what you're getting it cheaply. There's an element of tax efficiency, which we don't necessarily have to get into here, but makes them superior to most mutual funds in that sense. But mainly they're portfolios of bonds. What's great for retail investors is instead of going out and buying an individual bond and having to pay sort of a bid-ask spread that's very, very wide, that's the treatment you get when you're a retail investor trying to trade bonds or invest in bonds, I should say. With ETFs, you're having very, very low transaction costs. and you're getting to buy an entire portfolio of bonds. So that you're getting that built-in diversification, institutional pricing, and in most cases, I think almost all cases, professional management, taking care of those portfolios.
Yeah. Okay. That makes a lot of sense. And I know the mutual fund, the tax and ETFs are better from a tax efficient manner. And it feels like the market keeps going to ETFs versus mutual funds.
Yeah, I mean, look, it's still a very slow process. And you think it seems like a rapid rise, but it's off a low base. So, fixed income ETFs might not have hit 2 trillion in the US yet, maybe closer to 1.6. You've seen faster growth than in mutual funds, but in areas of the market like municipal bonds, high yield bonds, and we've probably read so much for years about high yield bond ETFs, and also investment grade corporate bonds. The mutual fund or more traditional investment vehicles are still much larger overall than ETFs. So in some ways, we're still maybe early stages for ETF adoption.
What are some of the ETF fixed income ETFs that you like at VanEck that are the most popular with VanEck investment?
Sure. Well, a few of our largest are actually our U.S. Fallen Angel high yield ETF. We launched the first Fallen Angel bond ETF in the U.S., and that buys only high yield bonds that were originally issued as investment grade bonds. Very unique sub asset class within high yield, and some very, very different performance dynamics. So that is one of our 3 largest funds here on the income side. Another is our high yield municipal bond ETF, HYD, and that is one of our oldest ETFs. That's been I think well over 15 years of a track record. So that's high yield municipal bonds on a national level. Believe it or not, our 3rd largest ETF, also near 3 billion AUM, is emerging market local currency bond ETF, and that buys, which may be interesting to people who are worried about U.S. debt and deficits and look at what's going on in EM. Although we tend not to try to sell EM local currency exposure to retail investors. Generally, that's an institutional product. 2 of our fastest growing strategies this year, a couple of them. One buys CLOs, investment grade rated collateralized loan obligations. Percentage wise, that's definitely been our fastest growing fund this year. And in the equity income space, but I think worth mentioning is business development companies, because via ETFs, it's a way to tap into sort of the whole movement toward private credit. So BizD is also one of our more popular and more rapidly growing income ETFs.
All right. Now I have so many questions. So, oh my God. Okay. I'll start here.
Sorry, you might have wanted 1 or 2. I gave
no.
you
You hit me on a lot though. So maybe this is more rapid fire, but the first thing, the Fallen Angel ETF that looks at bonds that were investment grade and now high yield. What is the approximate yield on that ETF, and what is the symbol?
The symbol is ANGL.
AN Alpha Nancy G Lisa. Okay, right? Yes.
Correct.
Okay.
Yeah. And the yield,
because I had to do that because the N and M people get confused. So
I know, absolutely.
Okay.
The yield is in the mid 6s. It's been about a 50 to 60 basis point give up in yield versus broad high yield, because it's about 87% of the index is still rated BB.
Okay.
So one thing about Fallen Angels, it tends to be the higher quality end of the high yield spectrum.
Okay. Then we talked about another one, but I want to move to the BDC. So what does BDC stand for?
Business development companies.
Right. And it's private credit, and private credit the past 2 years has been very popular. But to get in private credit, there are a lot of fees associated to that. Do ETFs reduce that? Are you investing in private companies in that ETF, or are you investing in public, or are you investing in both? Like, how does that work?
So that fund is simply buying a diversified portfolio of publicly traded business development companies. So in effect, you're realizing all the fees and expenses that those business development companies are incurring. So it's not it's not a way of adding cost efficiency. It's just more simply a way of accessing the entire public space in one trade, the entire publicly traded business development
And
company
what's you,
space.
you said the symbol. What's the symbol on that one again?
BizD, BIZD.
So would you be investing in that like in Aries, like their private? Is that how that works? So you're
Yeah.
okay. So you're buying a conglomerate of a bunch of these BDCs.
Yeah, there are roughly 25 or 26 that meet all the liquidity and market capitalization requirements to fit into this index. And yeah, that would be the largest one.
And how long has this one been around for, BizD?
More than a decade.
Oh, wow. So what's like the approximate, or if you don't know offhand, then fine, but what's the approximate return or?
Yeah, the 30-day SEC yield right now is still in the over 10%, by the way. So, and it's up more than that on the year to date. I mean, there's some correlation with the equity market in general on top of the attractive income. Look, with business development companies, you get equity-like volatility at times. So it's not, this is not the same as buying a investment grade corporate bond fund in that sense. But on the other hand, these become better and better managed vehicles over time. All the BDCs, highly professionalized. Their portfolios have gotten highly diversified. Most of the assets they own are, senior secured loans. Most of them are floating rate, so you've been insulated in those portfolios against rising rates. And of course, now some of the coupons that those business development companies are receiving on their loans may be going down as the Fed cuts, but they're earning very high spreads. Should mention, I mean, business development companies themselves are leveraged. They issue debt as well. So that therefore some of the volatility, and that's how you get the juicier yield as well. But on average, they're about 1 time levered.
Got it. That's interesting. So they're levered. So so they're borrowing at hopefully a lower rate and lending out at a higher rate, and that's why you get some leverage.
Yeah, and again, they're still 50% of their capital is equity capital as well. So
got it. So still 50% of their capital. Interesting. So in your role at VanEck, you've been there. Wait, what year did you start?
In my current capacity in 2012.
Okay.
So over 12 years.
That's when you started there?
Yeah, I had I was at VanEck previously in my career on an emerging market debt hedge fund that spun off. That was more of a distressed special situations type fund that literally spun off from VanEck. And eventually I found my way back.
Got it. You found your way
to
back.
do
Okay.
the fixed income ETF role here.
Yep. And the fixed income ETF market, I mean, one of the things people buy bonds, but buying fixed income ETFs is easier, right?
It's easier, and again, it's a lot cheaper. I mean, the vast majority of funds out there, particularly for the core part of people's portfolios, but even in high yield, or even the CLO ETFs, you're paying a penny, maybe sometimes 2 pennies bid ask spread to go out and buy these bonds individually, if you could even find them. And something like CLOs, you can't. Like, none of us as individual investors can even access that market. You're just getting it, really, really low cost of execution. And then you're getting it in the form of a very diversified portfolio.
So will ETFs continue to take share from the bond market then?
They should. And for two reasons, in addition to just the natural growth they've experienced, is mainly beta vehicles, passive, cheap exposure to various parts of the bond market. Because now ETFs continue to get into new areas of the bond market, so more in the asset-backed space and securitized space, thus the growth of CLO ETFs. And also we're seeing, an increasing number of active funds in ETF space, in both equity and fixed income. So
Yep.
the ETF vehicle is going to house a wider variety of strategies. And at the same time, I think across the board, we'll continue to see growth within the fixed income universe in general.
All right.
So the active funds can serve one purpose, but the traditional, more passive ETFs, they're building blocks that are just gaining greater and greater use, even by large institutional investors for model purposes, for liquidity purposes, for so many reasons.
Yeah. I mean, and it's, sometimes you don't know fully what you're getting with ETFs because like there's ETFs versus like the VU, like buying the S&P index. So there's a ETF SVOL. You get dividends, but you have to compare it to the VO. Like what I think, and that's why I asked about the BizD. Looking at track record, looking at historic track record is so important with ETFs because what I'm finding this day and age, a new ETF is started by, I don't know, I'm going to say maybe smaller companies without track records. And I think that, you got to be careful with that because it's trying to copy another strategy. But is the copy better or is the original? Like that's, I mean, at least for my investing, I'm not saying that I did bad in it, but it's just like that whole gamut of almost like separate it. Like when you buy, like I love the bond fund, the ETF that you talked about. I know it's a little bit over 6%, but I love the title of it. Like it used to be investment grade. Now they're high yield. And then you can, beat the market by a little or beat, what a treasury yield is. But most people aren't going to find that ETF. They're just not going to find it. Like it's kind of becoming like a little bit of a maze how to find these different ETFs. And then who has the track record.
It's a good point. And yeah, I do think track record matters, especially as we get into, trickier, more nuanced asset classes. And of course, with the advent of active in ETF space or the more rapid growth of it. And yeah, everything we launch, we think of the first phase as proof of concept. And for some of our potential investors, that could be a 3-year window where they need the concept to be proved. So, we launched a couple of, I call them, more intelligent ETFs in the corporate investment grade space a few years ago, which we don't have a lot of funds sort of in what you'd consider inside the ag.
Okay.
And these are two of them. One's all investment grade, one is triple B only. They've done great, like relative performance, but now we're past that 3-year window, and we'll see, for some of those investors who wanted that proof of concept, because these weren't generic indexes. There was a process to identifying relative value within these spaces. So yeah, a proof of concept is huge. Finding these strategies is getting more and more difficult because there are so many out there. One thing about Fallen Angels, by the way, I mean, sorry to be shameless in something of a plug, but just as an asset class, since indexes have been live almost 20 years now, they've outperformed broad high yield by 150 to 200 basis points a year, depending upon what indexes you're comparing. They didn't outperform them in 2022, sort of broke even last year. So it's not every single year, but that's in the cumulative annualized outperformance. So pretty interesting.
Okay. All right. So reminder, we got a special guest on, leads fixed income at VanEck, Fran Rodiloso, and has seen the markets ups and downs. So now I'm going to go to a little bit of crystal ball moment. 2025 is coming about in a few months. What's your read on where things are heading? I know, this changes daily, but economic factors, rates, inflation, what do you think investors should be watching closely? Take any part of what you want. I know that was a lot there, so to take any part of it.
Absolutely. Look, our default case is not for an immediate negative turn in the economy. So we see that sort of for now, still continuation of reasonable growth, but with sticky inflation. Yes, the Fed hiked and kept rates high for a long time, but financial conditions still appear to have been quite easy for a variety of reasons, still availability of capital. And so, if you look at all the evidence, it wasn't, one part of the massive evidence appeared tight, which was as a level of Fed funds, but every other part of the equation appeared loose. And you look at equity market returns and growth numbers, et cetera. So that's number one. Number two, there's still resource scarcity issues, potential deglobalization. Not my favorite term. And I don't actually think that's completely where we're headed, but certainly we have potential for some more barriers to trade or more expensive terms of trade, coming with the next administration. So that in and of itself is probably inflationary. We do have some questions of what might go on with the Fed itself, whom the leadership might be in that space going forward, how independent. So for a lot of reasons, let's put it this way, we're not that bullish on duration yet. We don't love the long end of the U.S. Treasury curve, even though everyone says rates are coming down. Well, they're not coming down at that part of the curve. And that's been our stance all year is, you might see Fed funds come down. You might even see 2-year yields come down, but that doesn't necessarily tell you where 10-year yields are going to, especially when you have a growing deficit, a growing debt load, and potentially less interest from some of the traditional buyers, particularly outside the U.S. That hasn't all come to fruition yet, but there are concerns that at some point some type of bond vigilantism will take hold and cause some havoc at the long end of the curve as well.
So I'm going to go basic. I don't understand one thing. So they're lowering. They are. The Fed lowered rates now twice. Okay. So the short-term rate that people would find in a savings account has come down a bit. The 10-year has not followed suit. It did for a minute. Sometimes people confuse mortgage rates with when they lower the rates, which I know it's based off the 10-year. For the 10-year to fall, what has to be true? What has to happen?
Well, several things could cause it. One is, the market lowers its long-term growth expectations. Another is the market lowers its long-term inflation expectations. Another is there's some type of risk-off event that simply leads to, a flight to safety. And despite the worsening and somewhat scary debt dynamics for U.S. sovereign debt at the moment, that is still, the number one sort of flight to safety trade, except for, outside of, say, some maybe hard assets like gold. Those are three things that could take 10-year yields lower. And look, it could just be a soft landing. Growth expectations don't have to get lower, but the market could become extremely confident that the Fed can keep inflation at or below 2%. We just don't believe that's where we're headed exactly. And we think there's still upside to 10-year yields and maybe out to 5% in 2025, even if Fed funds fell below 4% or toward 3.5%. That potential's there. And there's also potential for a rate shock higher, if we get some scary numbers on the inflation front. But there are obviously the three scenarios I stated where
if you get a crazy shock number on inflation, like where you're saying inflation goes up, say 6% or something, then you're saying the 10-year would go up.
Yeah, at least at first, at least the gut reaction to the Fed. All of a sudden, if the market shifted its belief that, well, right now it's been the Fed's behind the curve, inflation's coming down, they should have cut more. If that switches to, well, they're behind the curve, inflation's come roaring back, then you might see the whole yield curve shift up.
Yep. And so
if and when the Fed ever starts hiking again, you might see 10-year yields start coming down. It's long run expectations versus short-term moves that the Fed is going to be taking, and sometimes they're not in the same direction.
So if someone's listening to this Raz Report podcast today, and let's say they're 68 years old and they're retired, they just retired, okay, and they have they have a good amount of disposable income, but they want something very conservative to invest in. They typically would buy treasuries. Let's say a 6-month treasury at 4%. I don't know what they are, but 4%. Would you say that they should buy longer term things like the 10-year, like something like that? Like, what would you say? I mean, yes, let's buy some of the ETFs. Let's buy some BizD. Let's buy some Fallen Angels ETF. But you also mentioned those sometimes follow the equity markets. So I was like,
Yeah.
What would be something that you would say is conservative that you would put someone in that just wants income?
Yeah. And there are opportunities to manage different types of risk, right? So we talked about duration risk, there's credit risk, and you're right. Older investor, fixed income, relying on the stability of their capital base to keep earning that yield, and not really wanting to suffer capital losses. We probably wouldn't suggest high yield bonds or business development companies, but we might suggest maybe only going out as far as the mid, the belly of the curve, in between the 5 and 10 year, or owning, more than, in some environments, more short-term fixed income instruments, some medium term, and go a little light on the longer term, simply because the curve is normalized to the degree it's slightly upward sloping between 2-year and 10-year, but you're not getting paid extra yield to take that extra risk. But look, depends upon how much they have in savings. For a certain individual, they say, well, if I could lock in 4.35% annualized yield for 10 years, and I have I have enough saved, I'll take a little bit of the volatility if rates back up a lot from here, because I can stomach that. But if you look, a duration of 7, rates go up 1% this year, or duration of 9, I think, on some of the 10-year bonds out there. Anyway, you're down 9% on your investment if yields back up another 100 basis points, and so that's the risk. But if you're going to be sticking in for the full 10 years, you can weather that. So it depends on so many factors, but our base case is, look, manage your risks. You're getting paid to stay at the short end of the curve, so have more in short end fixed income maybe than you would in an environment where the yield curve is upward sloping to a greater degree. Number one. Number two, sometimes it's good to take on some additional credit risk because you're getting paid to take that risk. Credit spreads are historically tight right now. We don't think it's a great time to move way down the credit spectrum, but there are some quality, ways to do it in the investment grade space. Investment grade corporates still have healthy balance sheets. The spreads may be tight, but you could, take an additional 80, 90, 100 basis points over treasuries. That can matter a lot over, say, 5 years. And even, high rated investment grade CLOs, we like that asset class for a lot of purposes. Banks use AAA CLOs for cash management purposes. That's a proven super safe asset class. So, not saying every mom and pop should go into that space now, but maybe some of the ones with larger portfolios who are able to diversify, use a financial advisor, that could be pretty interesting. And one of the few areas where there's value, where spreads still represent some value versus some of the alternatives out there.
You're saying these CLOs, and it's the second time you mentioned it. I think some people are afraid of those because of what happened during, the whole mortgage market. Why are they safe?
Oh, yeah. So there was, the 2008, 2009 global financial crisis is one of the big things was sort of a blow up in collateralized debt obligations, all various types of of asset-backed type structures. CLOs existed back then. They've existed since the late 1990s. They actually suffered virtually no principal loss, especially at the AAA level. They did not experience any principal loss. So that was more about some global CDOs that invested in all types of bonds and other CDOs, and then a lot of subprime mortgage-backed structures. Those were the structures that actually blew up and suffered permanent loss. Look, all forms of credit, and especially securitized credit, did experience price volatility during that period. And so that's why I'm saying even today, the CLO structure is just super robust. It's not some pool of unknown mortgages scattered all over the country or in just in the Southwest with thousands of borrowers, and you don't know their motivations or their actual financials. The collateralized loan obligation, its asset portfolio is like 400 loans that a team of analysts are analyzing constantly, and they're dynamically managed. And they tend to have, the level of subordination for AAA CLOs is super high. So it's just been a super robust structure. We think it's appropriate for a lot of portfolios, but again, I wouldn't go out to every retail investor say you should own these. But for the ones who, are using advisors, we would say to their advisors, hey, it's your job to maybe come to understand these and see if they're useful, in some of your clients' portfolios because of the income they can generate, which is, for no interest rate duration, for broad investment grade CLOs, around 6% right now. But again,
do you have?
It is it's securitized credit. There's leverage underlying the structures. There's a level of nuance and sophistication that I'd still go back to the mantra. If you don't understand it, probably best to stay away from it, or only invest if someone you trust and with your money is recommending it.
Do you have ETF that's based on CLOs?
We have two. One invests in the broad investment grade space, so AAA down to BBB rated tranches, and one that is called broad mezzanine, which is really AA down to BB rated tranches. By the way, it is a nuanced space, and these are two of the income ETFs at VanEck that are actively managed. And to give you even more of a sense of how we feel about the asset class, every new product here, is it investable? Yes, this checked the box. Should it be passively managed? We didn't check that box. We said no. The third question is, can we manage it ourselves? And we said no. This requires a lot of experience, systems, a deep team. So we use a sub-advisor, PineBridge, who's been managing in the space for a long, long time, and they invest in CLO tranches from
what kind of yield
a variety.
Is it?
What's that?
What kind of yield?
It's over 6%.
And what are the? I know there's two. What are the two symbols on them?
CLOI is the one that we've launched back in 2022, June of 2022, and then that's the broad investment grade, so AAA down to BBB, and it's been mostly AAA, AA for most of its existence. And then CLOB is a newly launched fund, just a couple of months old, that invests in AA down to BB, and that's going to be more volatile, a riskier strategy with a yield pickup over CLOI.
Got it. All right. I know we're coming up on the end here. Anything I missed that we should talk about, VanEck? I think some of your guys will be at the FinTech Deal Day that we have coming up in New York. But anything I missed that we should talk about before we adjourn?
No, not that I can think of. I probably soaked up too much time with long answers anyway. So
well, I think it's very educational. Like, I think you go deep, and what I love most about this is you give the pros and cons of everything. Like, it was great. Like you said, hey, if you're this, like you gave the scenarios, why it's good, why it's bad. which I love because sometimes you just hear the positive and not the downside. And it's welcoming to hear the downside to, all the different scenarios that we were talking about. And so some of your answers, you had to do that. And it was great because I'm like, oh, okay, I should just go buy the Fallen Angels. Well, here's this, or, with the BDCs, buy ETF versus private, but you correspond with the equity markets because you're getting priced daily. And not exactly corresponding, but like there's options for everything. And ETFs and where VanEck is placed is right where, like, I just think the world is going. I just think that ETFs, everyone thinks they can beat the market until they can't. And then they say, okay, we should buy ETFs and make it my life easier.
Including myself.
Including myself. There you go.
And Jason, our CEO, Jan VanEck, he insists that every presentation we have, has at least a risk slide pointing out how, what the downsides are, how strategies don't work, or, and it's super important for us to try to communicate that. And obviously there's no such thing as a free lunch. We do think ETFs are a better vehicle for a lot of parts of the, investment universe. And so it's a cheaper lunch. But also, some great building blocks for portfolios. And so that's,
and that, Jan said with, the risk slide, the values go out the company, because I was impressed how you gave both scenarios every time. I was like, you didn't just say, hey, buy this ETF, buy BSD because of this. So I want to thank you, Fran, for coming on. Look them up, you guys. Head of fixed income, lead fixed income at VanEck. Rodiloso, spelled Rodilosso. It'll be on the screen anyway. But we appreciate you coming on. Benzinga, Raz Report, stories. I know Renato. Appreciate it. And we'll be in touch, and continued success for VanEck.
Thanks a lot. I really appreciate you having me on today.
Thank you. Thank you for coming on.